All right. So we're talking about economic moats. So tonight we want to finish up these concepts of economic moats. So this is the point in class it gets a little confusing. This always happens because you got a project. We talked about the project, and then I got to start talking about your second project, but you're working on the first project, so you can get them mixed up. So your first project is a team industry analysis, has nothing to do with your buy list, stocks that you put on your buy list. You're really focused on the industry. I saw a draft today of the media team. Very good draft, good shape. They identified the issues for them, um, and just kept the discussion with make sure this is focused on growth. So I asked them, what's the worst 2 words someone can say after you finish your presentation? You remember?
So what?
So what? So if your goal is to have a point to the whole thing. So if you do all this analysis, they're focus this and focus this, and then to say, well, so what? Is the industry growing or not growing? And their answer is streaming's growing, TV, print media, those things are shrinking, but which part of streaming is growing? And they've got an issue of it's hard for them to talk about streaming without talking about Meta and YouTube, but Meta and YouTube's not in their industry, it's in the next industry, but they got to talk about it because it's part of it. So it's really confusing. And they're struggling with how do you handle that? That's part of the industry side. It is tough. So I told them, make sure up front you're real clear. Hey, this industry is defined as this, but we're going to have to talk about YouTube and Meta some, even though it's not part of this industry. It's part of the competition for eyeballs. They're very different. One's subscription, one's an advertising model. So we're separating them. So there are things you may have to say up front. I'm going to meet with other teams on Thursday. We'll see where you're ready. They're going to be ready to present September 30th. So they might be the first one to go. They said, well, we think we can be ready next Tuesday. I said, no, that's next Tuesday you present to me, and then I'll give you one more week to clean things up. It's tougher with as a team, isn't it, than an individual? Because you've got to figure out what each other thinks. So it does add extra time. So they got good stuff there. What I haven't seen yet is their final conclusion, and I think they're still debating, is this a growing industry or is it a maturing industry? Where are they in that cycle? So separate the buy list. So you're doing the industry analysis, then you have your buy list. You're going to try to get to those 3 stocks down to 1. We're going to do some of that tonight. That's part of what the economic moat is. We'll talk some about that. Essentially, what you're going to do with your companies is a high-level analysis of the 3 that you have to try to get down to 1. Economic moats is a good way to do it. Look at those 3 companies and ask what's special about each one of them. What is it the main thing they have? Whether it's economic moats or value chain management. I was going to do a chat GPT on value chain management, but my chat GPT doesn't like me right now. It clocks forever, and then after it clocks 5 times, it says, sorry, you've made too many requests, even though they didn't answer any of them. So that's getting kind of irritating. And it's, I think, $20 a month. So do we have a chat GPT through UTSA? Yeah, I use Copilot to write macros in Excel, but I haven't tried it. So, but value chain management is a good way to go, and AI will give you a good one. You can find one, but y'all see the connection between value chain management and economic moats. You're trying to ask what is about this firm that gives it some competitive advantage. So let's finish up economic moats, and then I'm going to get into the financial analysis piece. I'm going to show you a spreadsheet I have built for that. You can do some analysis. So what we left on economic moats, we talked about patents, and then we got into brand recognition. If brand recognition is your economic moat, then your CapEx, your reinvestment in the firm, really should be focused on brand identity. That's where you really should be focusing. You know, obviously Adidas and Nike are going to be focusing on marketing. Which celebrities are they hiring? Because that's the brand identity. Brand identity is losing some of its power because it's the way the internet is changing with influencers. You can get brand identity much faster now than you could in the past. Actually, one of our microloans in Costa Rica, he started an Airbnb. And I actually told him, because I ride my bike there, there's a hill in Costa Rica that I think might be the hardest mountain biking hill in the world. I told him, hire some cyclist influencer challenge them to ride a hill, make a video of it, and you'll have bikers coming staying at your Airbnb just to try that hill, but he didn't want to do that. But he could spend a few $1,000 and probably pick up quite a few customers just by doing that. So it's much faster now to get your brand out there because of the way the world's working. It's still important, but not as much as it used to. I have Toys R Us out there that used to be a really, really great brand. Its debt holders somewhat drug it down and took it under. It took on a lot of debt, more debt than it should have. It's still a valuable brand. Someone bought the brand, they never could do anything with it, so it's gone. But many companies that traditionally had great brand recognition are starting to struggle with that. Maintaining the brand can get really, really expensive because, well, the media, where do you advertise now? There's just so many. If you have a fixed budget, or you can go to Meta, you're going to go to YouTube, or you're going to go to Google. How do you spread that around? And then with AI, so it's becoming more difficult to keep the brand. So firms often work at maintaining perception of their product is superior, but eventually you're going to have to win that. Your product actually has to be superior for you to keep that brand there. So how do you handle brand? There are websites that assess brands. Depends on your firm. Not every firm is brand recognition that important, but I give you 3 sites: Interbrand, International Brand Equity, and Cantor. Here's Interbrand. They will have lists where they'll show what are the most valuable brands today. Interbrand announces best Spanish brands. Interbrand announces best Japanese brands. So all kinds of analysis here. There's probably a search where you can find a particular company and find the brand there. I don't know if it does there. Here's Brands Insight. They have a best brand list. So it can be interesting. You can put that in your presentation. You want to say, hey, this particular website lists them as the most valuable brand, or the 5th most valuable brand, or the most valuable airline brand. If you want to say that, look at what they're saying. Read some of the words. Top 10 real estate brands, top 16 best car brands in the world, 2025. What do you think is the first one? Do you think Tesla still after this last year? So Volvo's number 16. Mazda, Subaru, Toyota. Wow, I'm surprised Toyota's that far down. Mercedes. Tesla's number 5. Kia. Wow. Lexus. But I mean, there's obviously some subjective here, but if the definition of brand is their margins, you would think Tesla would be number 1 because they have the best margins. But who knows? Maybe Ferrari should be the highest. They have the highest margins. So not exactly how they come up with it, but you have something to read that you can quote. So brands are important and should be, part of your analysis for a lot of companies. And there were some articles I can get for you. They're kind of old though now. I can see they're 10 years old, but The Economist has had some articles on branding. These are articles 10 years ago. So this issue of brands not being as valuable today as they used to be, they were writing about that 10 years ago. And just the internet sensation. Another one is switching costs. We're talking about that with media, how easy it is to switch between Netflix and YouTube and all these others now, Hulu. So if you have high switching costs, it's just really, really complex to switch from one provider to another. This is more B2B type of stuff, but it can be true. One of y'all might do Adobe. Adobe has some switching costs. A lot of time desktop publishing, people don't want to switch. They're used to it. It's, they have a heavy percentage of the market. People are just used to that product. So you get the switching costs. Akamai, those type of firms. So that could be true. Oracle. So their operations of their customers is complex, making it really costly to change. Probably not true for a lot of retail customers, but is definitely can be true on the corporate side. Oracle, tough to switch from. Salesforce versus Oracle, that's the competition has been going on for quite some while. Where do you reinvest if your moat is switching costs? It's on quality and functionality of your product. Because if you start falling behind, eventually the switching costs can be worth it to go. So you got to keep that product top notch. USA was always an Oracle shop. I don't know if they are still today. And then the network effect, you see this a lot where more users makes the platform more valuable. You know, it's the Uber effect. You can't compete with Uber because you don't have riders. You can't get riders because you don't have drivers. You can't get drivers because you don't have riders. It's that kind of effect. So Google, Facebook, Amazon, eBay. I don't know is eBay still a thing? I've never traded on eBay. Do y'all still use eBay? They got some pretty good competition now, right? I mean, there's a lot of people like Facebook is starting to compete, so it's a lot tougher now. So the focus on reinvestment there is the experience. You want the users on the platform using it as much as possible. There's been some really, really good business breakdowns and Acquired talking about how you get the users more involved in the platform so they're there, more engaged. So your focus on reinvestment should be on the engagement. You add features continuously, although I haven't noticed Facebook doing anything really too interesting in the last few years. They were adding something every year. I think they started getting a little irritating there, so maybe they stopped. But I don't know. Is anything Facebook's doing that's getting people to go out there? So I gotta get on Facebook. I can't think of anything.
They're reels and that's good. But I mean, everyone's been transitioning to that.
Yeah, something unique to actually get people on there. They've had some good experience of getting increased usage here in the last few years, but I don't think it's because of new features. These firms often will buy their competitors. You see that a lot with these big tech firms is just buy them out, get them out of the way so you don't have to worry about them. Can be an effective strategy. The Acquired episode on Facebook was really, really quite fascinating. Just hearing Zuckerberg's pretty aggressive guy, when he messes up, he goes full throttle to fix it and takes some pretty huge risks to fix it. And he's taking some big risks today. You really want to be the biggest. You want to have the volume so that you pick up the advertisers and you pick up more users. And then obviously economies of scale, that's a huge overlap with Porter's Five Forces. Heavy capital investment. It's just expensive. I used to think this with auto, but with Tesla and some of these you do have some new auto firms coming in and making pretty good dent. You usually see this, with the defense firms and others that, they just have huge advantage. Intel used to be in this category with their big fab plants. Artificial intelligence can be giving people an economic moat related to scope. Their knowledge is so vast that it's hard for other firms to keep up. It guards its deep knowledge very carefully. I don't know how NVIDIA keeps its employees from going to other firms. The banking side, it doesn't work at all. The banking side, people flip from bank to bank to bank. Hedge funds just cannot keep a competitive advantage because they hire each other's workers constantly. And they'll hire each other's workers entirely to know what the other one is doing. I don't know if y'all knew that game was going on. If you want to get a big raise in a hedge fund, you just switch hedge funds. You just say, I was at Credit Suisse once and they were all cheering. I said, what happened? What happened? Oh, we finally hired someone from one of our hedge fund competitors. It was the last one. We had an employee from every one of our competitors. We just hired one from there. So we now know what they're all doing. It's like, okay. So how does NVIDIA, NVIDIA is worried about their workers going to another firm. Are their workers starting their own firm and competing? How do you protect yourself from that? Because that's a huge economic moat as long as you can keep that to yourself. So you reinvest to maintain that. You keep your capital up to date and well maintained. Avoid obsolescence over time. There's a few podcasts on economic moats. This guy, Pat Dorsey, he has a firm where their entire philosophy is economic moats. So I bought his book. I thought, oh, this is cool. Read his book. I didn't like his book. So I don't recommend it. It only had one chapter on economic moats and it was pretty basic. And I got everything out of the podcast. So not anything bad about him. It was just a little too basic. But how do you know you have an economic moat? It gets back to that EVA again. You should have superior returns. So economic value added is a good way to look at it. If you really have an economic moat, you should have returns higher than your cost of capital pretty consistently. That source of profitability is sustainable. There's something they can do to keep the competitors away. So we just got a list of those things that have that protection. Pat Dorsey also says, ask how long can they keep them at bay? If it's a patent, like Lilly with the weight loss drugs, when does that patent run off? Although pharmaceuticals gotten pretty good at extending patents by slightly changing the makeup of the pill or whatever, but at some point, will that go away? And then, look at the industry competitive structure, use Porter's five forces. That gives you some insight as well on how sustainable it is. What Dorsey said was the number of moats is not as important as the strength of a moat. One really strong moat is better than three kind of mediocre moats. So it's a strength, it's not the number. Some moats are static. So Coca-Cola definitely has a brand advantage. It does provide them some extra income, but it's static, it's not growing. His argument is these can still be good firms if they're priced appropriately. They may not be priced as high growth firms, but they have good cash flows, predictable cash flows. So reinvestment essentially just maintains profitability. So some firms with moats that are not growing, but at least are static, they can be valuable because the firm is underpriced. Firms should allocate, this is what you talked about, their CapEx. So you do want to ask the question, what are they doing with CapEx, capital expenditures? So look at that number and ask what are they doing? Are they buying physical assets? Are they buying other firms? Exactly what are they doing to protect that economic moat? So he said the best firms allocate capital to strengthen the moat. Now, a statistic I used to try to use, it's a little hard to set up, but I like to look at their CapEx today or CapEx 2 years ago and their free cash flow today. So my argument is if they're investing $3 billion in CapEx, they should be doing it to increase their free cash flow, increase their economic value added. So I'm kind of interested in, did the CapEx 5 years ago benefit them 3 years ago or 2 years ago? So I'm trying to look at what's the benefit of the CapEx. Is that it really actually increasing free cash flow? Is it increasing return on capital? I could probably find this podcast, but it's a few years old. He does make the case that economic moats tend to cluster in certain industries more than others, and probably that changes over time as well. So he's saying right now, when he did this payment processors, which are pretty interesting. We use PayPal. I hate PayPal. Charity hates PayPal. It's so expensive. We beg people if they're going to send us 10,000 bucks, please don't send it by PayPal. It's going to cost us a fortune. Just send me a check. I can process the check. They're really expensive. So we started using Wise. Wise is wonderful. They're really cheap, but oh my word, their risk management tech, they're really hard to deal with on the paperwork side. So this is an industry that could be disrupted, but PayPal is pretty dominant in that industry. Obviously has some economic moats there. Business to business software. We talked some of that with Oracle. There's some definite economic moats there. I don't know if any of y'all are going to do investment market exchanges. Do you think of Moody's as a good investment? I think of it as a rating agency. I mean, pretty amazing. The economic moat Moody's has, very profitable firm. I think there's a business breakdown on Moody's. It has an economic moat. I mean, it's no question. Moody's has an economic moat. It's one that should have been destroyed after 2008, and they're actually as strong today as they were before 2008, so it didn't hurt them at all. So there are some industries where you just look at it and you have a dominant player. Who's the dominant players in payment processors? Visa, MasterCard. So yeah, if you think about Visa, MasterCard, I mean, it's pretty amazing. Why do you use Visa? Because everybody accepts it. Why does everybody accept it? Because everybody has it. So we started a restaurant in the jungles of Costa Rica. They accept Visa. I don't know how they did it. It's kind of interesting. So it's they have a process to put new vendors on. Every new vendor is going to get on Visa, and how do you compete with that? It's pretty amazing. So anyway, so some of your industries, economic moats, pretty central to what they do, pretty important, and it probably pretty sustainable for quite some time. One other podcast was Connor Leonard. I thought he was just interesting. He talked about legacy moats. This is kind of a traditional moat tied usually to brand name. They struggle with reinvestment. What are they going to do with CapEx? They tend to be cash generators that are like, what do we do with all this money? Reinvestment moats, they're strong moats, but they have significant capital requirements that just make it expensive to reinvest in the firm. And then his favorite are capital light compounders. These are ones that have that network effect. They dominate a particular market. They can shut out rivals without a significant amount of CapEx. It's like the perfect firm. Subscriptions-based service. They're the first ones out there. They pick up everybody. So his podcast was kind of interesting. He doesn't have a book though to look at. So there's economic moats. That's really going to come in when you have 3 or 4 firms. You're trying to get down to one. You should do a high level value chain management, economic moat analysis of it to try to figure out who these 4 companies are, where do they excel. And then let me show you what you'll do after that. But any questions on, I don't know if y'all have had this before. You should have had porters before. I don't think we do value chain management much at UTSA that I know. Have y'all seen that?
Yeah.
Maybe in strategy?
We did it in management strategy.
Management strategy. We should do it in finance, but you see it a lot in finance. So so you want to be using those type of phrases, that type of jargon when you interview in this industry, because you do see it quite. You see porters a lot, but you'll see value chain management quite a bit. And it is well enough known that you can put it into an AI model and get a pretty good report out. All right, so where do we go next? So let me show you what you're going to be doing with your individual stocks. So you have a short buy list. So you want to do a high level value chain management analysis, economic moat analysis of the companies. High level though. The real key is what's unique about this company? What is the biggest strength? So start with that with each one of them. You're going to do a financial analysis. We have an Excel template. It's already set up. I've already done all the work. So you just got to plug in a ticker and you've got it. I'll show you that. Then you're going to do evaluation, ECF, investment bank, and relative value. So you're going to do this for your 3 or 4 or whatever companies you have. I think on airlines are going to be 4, right? So it's not too difficult to do 4. Y'all going to do Ryanair, right? So I need to add Ryanair to our database because I don't have 9. If you have a non-US company, and they're going to have the same issue when they do auto because we're going to add non-US.
One of the 4 companies was private.
Yeah, we'll just have to kick it out. Yeah. So if you want to do non-US companies, I have to add it to the database.
You mean investment bank?
I'll show you. It's the typical model you see in investment banks. Yeah, it's a capital IQ model, but I use they set it up, they like to do things very much like you'd see, like you went to JP Morgan, you use that model, it's pretty common there, so you'll see it. Carson, yeah, but
I had the same question.
Right. Yeah, so maybe I should just say capital AQ model. So this is sweet. This is sweet. So just say you're using sweet models in your evaluation. So I built those and I'm stealing from Cap IQ on this one. I looked on Bloomberg for some, but Cap IQ is just a better model, works really, really well. So what you're trying to do is decide on the final stock for your pitch. Remember, we'll do start the stock pitches in late October, so we're about a month out. So you'll want, while you're finalizing up your industry analysis, start doing some work on that. I'll show you the finance. You can start on this first part. Right now, look at those companies and start asking that question, what makes your company unique? And then tonight, I'm going to show you this, right? We sent out an email to all the CFAs in town, listen to our pitches, and so far 5 people have replied, so I'll keep trying. I emailed a bunch of people at Victory Capital and they said they would participate. Victory Capital just sent me a job today, but unfortunately it's an internship. I'm not sure any of y'all are interested in interns, but if you are, come talk to me. I'll send your name over. It's a fixed income internship, but Victory Capital is for next summer. So if you're graduating, they probably don't want to talk to you, but
Do they have, they employed one of our students last time around. Do they have his contact info? We could get that, the kid that got the last internship to talk about it.
we could talk to Kevin. He's on the trade desk. They have Amora. I can never remember how to say her name, but she's there. Patrick's there. And that's a good point. I could probably get Patrick to come talk.
Just talk about the internship, but it's probably.
Well, Patrick did the intern.
Oh, okay. Just anyone who's done it.
And Nathan did the intern. I don't know about the lady she did. But yeah, that's a good point. I should probably have Patrick. I should show y'all Patrick's paper that he wrote in this class. Did I show y'all that one, Reed, the Microsoft one?
No.
It's a scary paper. I mean, it is a scary paper. I showed it at a conference once with Patrick's approval, and they're like, "There's no way an undergraduate student wrote that paper." And so, no, he wrote the paper. It's like 100 and something pages, and it's really intense. I go, Patrick, you need to be an analyst. And so they finally hired him. I said, Patrick, just go to Victory Capital and show them that paper, and they will hire you on the spot. And they did. So I need to get him come talk. He's a good analyst. All right, so there's where we are. So we've covered this. All right, so I'm not going to talk about that anymore. You can use AI to do that. You can go to IBIS World and do that. So looking for that value chain management analysis. So let's talk about financial analysis. Let me give you the template in Word first so you can see where we're going. So we're going to start off with 2 high-level questions. Financial analysis. Now this is my template. It's a pretty common template. There's a few places where I'm a little bizarre, but not too much. When I was at UTSA, they hired a guy to come in and teach management courses, but he had no experience in insurance and banking, and so they asked me to come teach along with them. And his template was almost exactly this same template. It looks really different when you apply it to a bank or an insurance company. So we'll see that next semester. But outside of insurance and banking, this works really, really well. The first question you want to do is ask about short-term viability. Will this firm be in business in 5 years? Most of the firms you're looking at, that's not going to be a serious issue, but you still need to look at it and make sure. It was funny in the executive MBA program a few years ago. They have a big case competition the last semester with a panel. And the whole purpose was the case. They gave them a company that was struggling to survive. And the case was really about what do they need to survive. But every single team missed that. they're all talking about acquiring other firms, major growth strategies, and like this is a firm about to go out of business. Like you're not going to be doing so they all miss that. So make sure you do that and make sure your firm is viable. But if your firm is viable, then you're looking at long-term prospects of growth. And this is really what you focus in on because growth is what we're after. Remember on your industry analysis, it's all about growth. Is this a growth story? We love growth when we're buying stocks. That's what we're actually buying. Short-term viability, we're going to break into two pieces, liquidity and solvency. Liquidity is the hardest. Well, look at that. There's some ratios you're supposed to use that I don't like, so I won't use them. So you'll be kind of shocked that you won't see current ratios, but I'll show you the ratios I like to use. Long-term prospects, we talked about the top line and the bottom line. Top line's also known as turnover. Bottom line is the margins. So growth comes from two places. So I was talking to the media people. If you have growth, where is it coming from? Is it revenue growth? Or is it the fact that you're growing, but you have wider margins? Because maybe it's cheaper to produce a show using AI than actual actors or whatever. So your growth can come from more customers, or your growth can come from more efficiency. You're doing things much cheaper, so you have wider margins, can come from either place. For short-term viability, we're going to do a final conclusion. And then we're going to look at things there. Conclusion, like quality of earnings. We'll also look at credit ratings. I like looking at credit ratings. My model brings in credit ratings. My idea of credit ratings is it's an outside source confirming what you already believe. And credit agencies are pretty good at what they do. Pretty good analysis. I had a big debate at USAA. Their procurement department was going to hire all these analysts to do credit analysis of their vendors. And it's like, you know, you got like 50 credit analysts sitting over in the investment company that could do that for you for free if you wanted to. And they're like, no, we're going to hire our own people. The ratings are a really good source. I mean, let's say you say, man, this firm is great, very viable, no problems, and they're rated single B. Does that seem consistent? I don't want to, you know, I should have mentioned this up here. What's a quick way to get rid of your short buy list? I should have mentioned that. Do we want single B rated companies in our stock portfolio? We had that in our screening, right? We use that Bloomberg function. I can take a double B firm, but do y'all want single B? How weak is single B? That's pretty bad. You know that Netflix was single B there for a while. Right. So, well, it was back when their cash from operations was like $3 billion negative, and they had massive amounts of debt. So since the firm was betting, it was really interesting time because the firm had heavy debt, huge negative cash from operations. They're putting a fortune into production. So the bond market was going, man, this firm has no cash, heavy debt. The stock market was excited. This firm's building huge growth. So the stock market loved it and the bond market hated it. So there may be a single B company. What about triple C? I would never own a triple C company. And their triple C company needs a miracle. And it might get it, but I don't think we want triple C companies. Because there you're just, are they going to survive? Right? So single B, maybe in your dreams, but pretty rare. Right? I'm nervous about single B. It's on the cusp. Once you get down to triple C, you're in troubles. So if we go into recession, and you're going to be in a lot of trouble. That's a really, really struggling firm. So that's one thing. How do you get credit ratings on Bloomberg? You just type your firm, hit the equity button, and then CRPT, credit report. And that will give you all their credit ratings, and you can see real quickly. But it's also on this template. So if you do the template, you'll get credit ratings as well. All right, so we'll use credit ratings as a way to quickly just reassess. If you say the firm is horrible, they have serious liquidity problems, serious solvency problems, and they're double A rated, that doesn't seem consistent either. Double A is a really good rating today. I mean, there's not many triple A left, right? You got Microsoft and Johnson, and that's about it. So double A is really top notch. So if you disagree with the rating agencies, you might reassess what you're looking for up here. On turnover and margin, we're going to summarize this doing ROE decomposition. You might consider that its own category. You've done that in other classes, I assume, right? Everyone done decomposition of ROE? If you haven't, we'll do it in here. I do it slightly differently, but you may have done it in accounting classes. The accounting classes I've seen, they don't do a good job of separating out the debt side. So when they do margins, they have interest expense in the margin. I bring interest expense out and put it over with the leverage. So that may be one difference, but we'll see. It's already set up to do that. ROE decomposition actually covers liquidity, solvency, turnover, and margin. Really looks at all of those. So that's pretty good. So that template works. It actually works for banks and insurance companies, but banks don't use the word turnover. They have margins, but they're different type of margins, so it's a little different. But the general framework works. It's when we get into the details that it gets a little tricky. So the things we're going to look at on liquidity are working capital, degree and use of free cash flow. So we're going to look at those two items. Working capital is a really critical one. And this is where a lot of students struggle because it sounds a lot different than your accounting classes. So I may show you a business breakdown video next class. Can't do it tonight, but I'll show you one. Business breakdown gets it correct on working capital. But if an accountant were to listen to that, they would say, wait, what did they just say? So business breakdown will say, this firm has negative working capital, and they mean it as a compliment, that it's a good thing. An accountant would say, wow, why would you want negative working capital? So we'll talk about that. We'll spend quite a bit of time on that. Degree of free cash flow. We'll get in, there's a few ways to look at free cash flow. You can actually calculate it. I don't actually have free cash flow in the model. What I have is how it's used. So I'm using a book that I really highly recommend. And I don't think it's on my book reading list, so I should find it. It's called Shareholder Yield. So it's right here, Shareholder Yield by William Priest. Have any of y'all read this yet? A short book. So William Priest, when I retired from USA, I did a trip to New York to visit a bunch of firms, kind of my swan song. We didn't have money with his firm, but I went to his firm just to get his autograph on the book. And he wasn't there. So William Priest, it's a really good book. So we're going to talk about what he says with free cash flow is he thinks it's tricky to calculate. There's just some debate. There are general formulas on how to calculate it, but he says one thing for sure, if a firm has free cash flow, you'll notice it because of how they spend it. And so he talks about not the calculation of free cash flow. He talks about firms that have produced free cash flows that you see them doing. He says it's the evidence. So what does a firm producing free cash flow do? It pays dividends, it buys back its stock, it pays down its debt, it does CapEx, it holds a lot of cash. He's saying we got firms that if they have free cash flow, you should notice those type of things. And so that's the way I have it set up. In our template is, does this firm show evidence that they're producing free cash flow, and is it coming out in the numbers consistently over time? Some of you might have a firm that's buying its stock back. It buys $2 billion of its stock back, and it's got $2 billion in added debt. What does that tell you? You borrow $2 billion to buy your stock back. Does that sound like a firm producing free cash flow? Doesn't sound like it, right? You have to borrow money. So we'll see. You're gonna, a lot of you are doing that. So we'll do that. On solvency, we're going to use the traditional ones, times interest earned. And well, not so traditional. That won't be traditional. A lot of your classes talk about debt to equity. Maybe I'll use debt to equity before. So I don't know anyone in practice that uses debt to equity. What's the common one today? EBITDA, yeah. And we'll have to decide. I think I use net debt to EBITDA, but some of you are going to see that can be an issue. We'll talk about that. A firm like Apple looks like it has a lot of debt, but has a lot of cash. So when you subtract cash out, the net debt is actually negative. So we'll see there are some issues there, but we'll use debt and we'll talk about that. Why we're using debt to EBITDA, not debt to equity. On quality earnings, what I like to do here is I like to look at net income versus CFO over time. If management is cooking the books, there's a great book there I highly recommend. Let me see if I can find it. Yeah, everybody got this book? This book's really short too. It's only like 200 pages long.
Free on the UTSA library.
It's free in the library. Okay, there you go. It only has 3.5 stars, but it's better than that. This book by Howard Schultz, really good book. I wish I could show you the. I don't know how to do the index anymore in Yahoo. I mean, in Amazon. But really good book. He's a forensic accountant. He's helping you know can you tell management is hiding something or exaggerating something. And he goes through chapter by chapter. How does management recognize revenue that's not really there? How do they delay expenses that they should have taken this year? How do they move up expenses that really belong in next year? He goes through each one. What he says, when you take the 3 financial statements, the income statement, balance sheet, cash flow statement, if you lie on one of the statements, you'll have to lie on another one. And he shows you how you can bring the statements together to figure out that they're lying. So I'm taking his most basic one. I'm just saying, if management is doing something devious, you'll see some big detours between net income and cash from operations. So what's the biggest way management lies? It's through accruals. What do accruals do? They prop up net income, but they don't help you on cash from operations. So he has some really interesting stories in this book. So I don't know if I recommend that book, but I think I do. I think you might want to have that on. It's called Financial Shenanigans. And I'm not exactly how to say his last name, but anyway, I don't know if there's another T-I right there, but anyway, I don't want to accidentally say something wrong. But anyway, that's the book. He had his own firm, and then his firm got bought out by somebody, but he used to freelance that you could just send him a few $100 and he would do a red flag analysis of your company. I'm not saying you should do that, but I mean, it would be pretty interesting. I'm sure he has an Excel spreadsheet now that he would do something like that. It's got 4.6 stars, even higher than William Priest. So it's a good book. I don't know if he's still alive or not. All right, so you're going to do a couple of things on liquidity, a couple of things on time interest earned, then we're going to do quality of earnings and then just credit ratings. Pretty straightforward. If your firm doesn't have a credit rating, we'll use the Bloomberg score, because all of your firms will have the Bloomberg score, which gives you a pretty good indication. On turnover, the most obvious, all of y'all were using this in your screening models. The most obvious thing is just look at revenue growth. That's what turnover is. In fact, in the UK, when they use the word turnover, they actually mean the dollar amount of revenue. They use the word turnover to mean revenue. It's confusing to me when I when I hear the word turnover, I think of a ratio, a formula. Their turnover is the actual dollars. So revenue growth, that's pretty straightforward, right? Something you have to do that I don't have in this spreadsheet, but you might want to think about is volume versus price. Because we've had quite a bit of inflation here recently. So if I'm looking, so like the consumer discretionary, they may say, wow, airline revenues are up a bunch this year, but ticket prices are up a bunch this year. So you might want to say, yeah, revenues are up, but how many miles flown? How does that change? So if I were doing airlines, I would probably look at passenger seat miles this year. How many miles do people actually fly versus pre-COVID? Are we back to pre-COVID levels? So the revenues may be up because prices are up, but prices are up because fuel costs are up and salary costs are up. So revenue growth, and then we're going to talk actual turnover. We're going to that versus capacity. We'll talk quite a bit about that. I mentioned that some last week. Where's the growth coming from? So if you take a Walmart, they grow their revenues 5%, but they added 4% more square feet. They, a lot of the growth came from them putting buildings down, which is pretty expensive. You got to spend all that capital. So where are you getting growth from? And this word capacity is going to be different for each of you. And we may have to change the spreadsheet for you. The ones I built are revenue per square foot, revenue per store, revenue per employee, and revenue per property, plant, and equipment. Those are the 4 that I have. But if you're doing a cruise line, what would you do? So you're thinking about what is it that they do that produces revenue? For Walmart, it's to build more stores. For NVIDIA, it's to hire more employees. So what would Carnival Cruise do? More cabins, more berths, so revenue per berth. What would an airline do? We talked about that, right? Available seat miles. So you want to know how many seats you have flying, how many miles. And it's not really how many planes, because you have 20 more planes, but you only fly them once a month. It's how many flights you have times seat times mile. So those are the kind of things you're looking at. So there are some really unique ones here. And what we're looking at is, where is the revenue growth coming from? Is it coming because you're actually generating more traffic, getting more customers, or is it coming because you're building more ships, building more stores? So that's what we're looking at. And then the last one, just real basic, we will do an asset turnover. Anybody remember turnover ratio? What's in the numerator? What's in the denominator? Revenue to assets. So whenever you see the word turnover, you have revenue in the numerator. What's accounts receivable turnover? So asset turnover is revenue to assets. So whatever in the title, you put in the denominator, you put revenue numerator. So what would accounts receivable turnover be? Revenue to accounts receivable. What would inventory turnover be? So yeah, but not quite. Cost of goods sold to inventory. All right. So a turnover, you're looking at the revenue versus the energy you had to put in to produce that revenue. All right. So that's what you're looking at there. Do you want a higher number or a lower number? Higher is better. All right. Pretty straightforward. Higher is better. All right. Bottom line. Here we're looking at gross margin and net margin. But how do we define, how many net margins are there? There's net income margin. There's EBIT margin. There's EBITDA margin. There's operating margin. I think it's real important that you don't say net margin. You need to say exactly what it is. Are you doing EBIT margin, EBITDA margin, operating margin? I don't like operating margin because I don't think it's as well defined as the others. But I was watching the CFI video, and they said, how do you create these margins? Do you start at the top and work down, or you start at the bottom? You start at the bottom, you add back interest, tax, depreciation, or you start at the top and get down to it. They preferred, like most people, to start at the bottom and add back. But that's a net margin. Anytime you see the word margin, what's always in the denominator? So on turnover, revenue is always in the numerator and the title's in the denominator. What about margins? What's always in the denominator and margin? Always revenue, right? Turnover, it's revenue divided by something. Margin, it's something divided by revenue. What do you divide it by? What do you divide into it? Net income divided by revenue, EBIT divided by revenue, EBITDA, operating income. So margin is something divided by revenue. So it's your profitability. We may talk some about gross margins because there you get the accountants involved. I don't think the accounting classes taught you enough about cost of goods sold. What is in the cost of goods sold? How to decide, put it in there. I think it's messy. I know at USAA, I saw the massive amount of flexibility the accountants had deciding what goes in the cost of goods sold and what doesn't. So hopefully your firms are consistent over time, but it is possible comparing two firms, you can have some difference. He was saying most firms put depreciation up in cost of goods sold, but I think it really depends on what the business is. Did your accounting classes spend a lot of time on cost of goods sold? It was kind of given, wasn't it? But you just knew, obviously. Well, USAA, cost of goods sold, that's claims, paying claims. That's a lawyer, okay? Well, which lawyer's time do you put in there? Well, you got claims adjusters, okay, you put all their time in there. But there's the chief lawyer. Do you put any of his or her time in there? Well, yeah, how much time do you put in there? I think we talked about this before, right? It's gonna be some time survey. That person might put 10%, 5%, 20%, who knows? So there's a lot of subjectivity there. You can change the numbers around somewhat. So I'm a little leery of this, but I do hope firms are very consistent over time. And they probably are just because of inertia, because you don't want to have to revisit this debate every single time. But there is some flexibility there. But gross margins are important, especially after 2022 with the high inflation. A lot of firms were seeing margins compressed, and you are starting to see margins compress, and a lot of times that goes through gross margin. So those are the two things we're looking at there. At USAA, I won't do this one, but I thought it was pretty good. They looked at revenue growth versus expense growth. And essentially what they were looking for was operating margin. We'll talk about this. If a firm has fixed costs, you would expect revenues to grow faster than costs. You'd expect to see margins expanding. In fact, I don't know if y'all don't remember, it's been too long, but USA did a restructuring where they let go of 25% of their workforce. This is the reason they did it. Revenues are growing 3%, expenses are growing like 15%. And Bob Davis said, hey, we're going out of business. Our expense ratio was 29-30%. Geico's was 18%. Does that sound like a firm that needs a restructure? Serious problems. So I kind of got in the habit of doing this. Look at their revenue growth versus look at their expense growth. You would think most firms would have fixed costs such that revenue growth should be faster. But the reason I stopped doing this ratio is because most firms, that wasn't the case. Most firms, their revenues were growing slower than their expenses, which means the revenues are growing faster than the net income. I mean, it was the exact opposite of what I expected. And that was a lot of firms. So I took that out, but it is somewhat what you're talking about here. Does the firm have operating? We'll talk about operating leverage. Does a firm have some operating leverage such that as their revenues grow 5%, their earnings will grow 6, 7, 8, 9%? Is operating leverage good? Is fixed costs good? What does fixed costs do to you? It makes your earnings grow really fast and it makes you much more volatile. It's bad in a recession. It's great in a growth. So is it good or bad? You know, we may talk about Spotify versus Netflix when it comes to operating leverage and just the different approaches there. And then ROE decomposition, we'll bring all these together. We'll break up ROE into its component parts to try to see where they're coming from. But essentially, it's going to be asset turnover times margin times the tax impact times financial leverage times the interest impact. That's going to give us our return on equity. We want to see where is the return on equity coming from. If their return on equity is going up because they're taking on a lot of debt, that's probably not a good reason ROE is going up. It's possible the ROE is flat or declining, but they've been paying down debt. In that case, you got a good story because the reason ROE is coming down is because leverage is coming down. So we'll talk about that. So really, really important. Here, we're talking about operating leverage. Here, we're really focusing on financial leverage. The spreadsheet, I have it set up so you can see these component parts and start seeing what's going on with this firm. This manage, I think about it as management adding value. You want the ROE to be higher, but you want it to be higher for good reasons. Is it higher because they're improving their turnover? Is it higher because they're improving their margins? You hope that all their value add isn't coming from the tax department. Right? Are any of y'all buying stocks because of tax advantages that they have? Probably not, but you hope that's not the case. Other tax accountants might be in jail in a couple of years if they do too much. But we're going to break it up and look at it, but it's essentially a summary of what we've already done. All right, so there's the template, and I've got it built. All right, so I've already done all the work. I've done 95% of work. You got to do the last 5%. Guess what the hardest part of the work is? The last 5%. So I did the 95% easy part. Right? But that's the way it should be, right? Most college classes, they give you the hard stuff and ask you to do the easy stuff. I'm going to give you the easy stuff and ask you to do the hard stuff. All right. Makes a lot more sense. So have y'all seen this spreadsheet? It's out there on Canvas. It's under financial analysis. It's this right here, Excel company financial. I'm going to add one more spreadsheet. I made a change to this one. I'll have it out there twice. When you open it, it has a tutorial on how to get your companies in. You need capital IQ. Do y'all have capital IQ at home? I learned it. I do have a video that shows you how to get capital IQ. If you need that, let me know. So this shows you how to set it up. The second page is the Russell 3000. This is where I've got to make some adjustments if you pick a non-US company. So if you do Toyota or Ryanair, I mean, I asked them to put Ryan in there. And how did Ryanair score? number one, right? The best one and the most expensive one. It's a great company. It's kind of stole the playbook from Southwest Airlines and it's just done extremely well. So I probably would want Hyundai and Honda and Toyota in the auto side.
For the industry analysis, is expanding on the global with respect to useful.
It just depends. Where I was talking to media is let's say restaurants. You could probably focus very much in the US, just US companies and US customers. Media might just use US companies, but they may talk about global expansion. If you're doing energy, you're probably going to have to bring in British Petroleum. It's a global industry. So some industry like airlines, like autos, like energy, you really do need to go global. Restaurants, you can just focus in on the US companies. You can always bring in international firms, but you do restaurants international, you're talking some pretty small companies that just aren't that global at all.
What about semiconductor manufacturing?
Well, TSMC and what's the machinery one? ASM.
I think it's ASML.
ASML. Yeah, I mean, I probably wouldn't include them, but we got to see. They have to have an American deposit receipt. If we do that, we can probably get most of the data, but you may find a few NAs in a few places. I forget on Ryanair, didn't we have to kick out something on them? Didn't we like price the book or something? There was something that the data didn't come in. I've done Toyota before and it worked okay. Now the question is, can we buy non-US stocks in our portfolio? So it's going to create some currency risk because I think some people think you run ADR, you eliminate the currency risk, but you still have it. It's price in dollars, but you still see it coming through. So, but I have the Russell 3000. So these are all US companies. What you have to do is sort this, and the video shows you how to do it. Sort it so that you get the companies you want to compare. So here I'm doing Walmart. So Walmart's on the top line. It's got the number 2 next to it. And here's all my competitors. I set that up here. Once I set it up here, I'm going to bring that over to this page. you gotta be a little bit careful on this page, because this page has 27 companies in it. If you only bring over 15 companies, then you're gonna have 12 companies that don't belong. So you might, the first thing you do is just get rid of the first few. So, I mean, the last few, but anyway, you'll see it in the video. So what you're trying to do is bring in your company and all the competitors. And there's different ways you can bring in competitors. Sometimes it's pretty obvious. Sometimes, I could probably bring Amazon in here. There's probably some consumer discretionary I was bringing in here, Macy's or others. So you could bring it down. The spreadsheet is set up for 50 companies. So if you bring in 120 companies, that's fine, but it's only gonna look at the 50 largest. If you bring in fewer than 50, then it will just stop where you stop. I would have at least 20 companies in your comparison. With airlines, you probably can't do that, but, and they brought, what was that company? Joby? Yeah, that was yeah, I didn't realize that was publicly traded. Would you use their product?
Yeah, I would
Would you really? Without a pilot?
be the pilot.
Yeah, well, I don't know. Spend $10,000 to go across Manhattan. But yeah, I mean, it would be, yeah, I have a fear of heights, so I don't know if I would do it. All right, so once you have that, the next sheet just does all the work. The only thing you have to do in the next sheet is type your company name in the way you want it to be on the graphs. And don't type Walmart Incorporated Inc. of whatever, because it won't fit on the graphs. So keep it short. You can just put the ticker in there if you like. And then after that, it has a page of all the data. You can see you got the credit ratings down here. We're going to walk through this. I'm going to help you. How do you do this analysis? And then it has a page of all the graphs. All right. Now, what I've added to this that I think you might want to do is I added an additional analysis where I do graphs just of the companies I'm interested in. Let me show you, well, like here, this is a good example here. Here I have Costco, Target, and Walmart. Who stands out here? Yeah, it's just off the charts. Costco, revenue per square foot. So I do have it so you can compare 3 companies. So if you're looking at 3 companies, you can look at all 3 of them together in one place. And this is set up to help you do that as well. After that, you don't really need this spreadsheet anymore. Here's the Capital IQ data. On here, I've actually did it as numbers. It doesn't, but the spreadsheet I send you actually has the formulas. So you'll bring in the data. The data for graphs, this is just, you might use this. This is all the data to build all the graphs. So you might find a company that is like 20%, 19%, 20%, 47,000%, 12%, 19%. You might want to just delete that 49,000% and get it off the graph. So there's a few places you might edit this if it looks terrible, but mostly you won't really use this one. Here's the same thing, but here where I'm just bringing in the companies I want to look at. So if you're interested in this, all you got to do is make sure you pick up the right company there. There's nothing after that for you to use. So you're really going to be focusing in on print page 1 and the graphs. We'll walk through it, but I have an example of that analysis that I did for Walmart that's right there in Word. You're not going to actually write that, but you're going to go through that analysis and looking for keys for your companies that separates them. Some of these graphs you might use in your pitch book for your company you use, but you're going to have all the graphs there, and we'll walk through what you're looking for, what kind of analysis you're going to do. But it's all there. It's all set up. Right now, it's about 10% Bloomberg and 90% Capital IQ. It used to be 100% Bloomberg, so you had to have a Bloomberg machine. And then I decided to teach myself Capital IQ, so I converted it to Capital IQ. There's a few ratios I cannot get out of Capital IQ that I can get out of Bloomberg. Now, if you know Capital IQ, you can bring in other things. I think I have receivables turnover, inventory turnover in there, but there might be a few other ratios you might be interested in. Capital IQ, I don't know if y'all know how to use Capital IQ, but if you just, they have a field search, you do the field search, type it, find what you're looking for, insert it, and then you can just copy the formulas above, down. You have to build your own graphs, but you can bring other stuff in there. So CapIQ is pretty easy to use. If you look at the graphs, you'll do some editing of the graphs. So the way I do the graphs, you look at times interest earned. I have the industry median. I have Walmart. I have the 90th percentile. I have the 10th percentile. There's sometimes where you'll just go into the graph and click off on one of these because it just doesn't look good. I did the wrong one, but so there's times where the 10% and the 90% are just so wide and mess up the graph. You can just click them off and just show it. So always show the median. You want to know what that is. For Costco, I leave the 0.1% and 0.9% in there because I want to show that Costco is actually above that line. That's how strong they are. They're off the charts. So it kind of depends what you're looking at. But there's times they'll leave one out. Here's debt to EBITDA. You can see that's pretty high up there. So you might take the 90th percent out. The key, whether you leave it out or not, you need to see your company. And is your company above or below? So Walmart looks pretty okay here. Their debt to EBITDA is pretty low versus the industry. So you can edit it around. On the turnover ratios, I gave you choices. We'll talk about this quite a bit, but Costco does well even on revenue per employee. But if you're not sure which one to use, we can talk about it. Typically on tech stocks, it's revenue per employee. USAA was revenue per employee. We always use revenue per employee for all our entities, the bank, insurance, P&C, and life. Bob Davis loved revenue per employee. It's a good catch-all. Are y'all doing Disney? Is that on your buy list?
Yeah, yes.
Yeah, there is no good rate turnover from Disney. I've never found a good one for Disney. So Disney's revenue per employees looks horrible because of all those cruise line and theme park employees. It just looks disastrous. Revenue per property equipment doesn't make sense. Revenue per square foot. I know they have stores, but that doesn't make sense. So what would you do with Disney? You probably have a different ratio for each segment. We can't do that. So it may not work for everyone. So you might be then just really relying on asset turnover. What's the formula for asset turnover? If y'all been listening to me? Revenue to assets. So Costco again is just off the charts on that one. This isn't Costco. Costco is actually above the 0.9%. There's your gross margin, your net margin. I don't like this title. I should have changed it. I believe that's an EBITDA margin, so I kind of violated my own rules. But there's your net margin. So anyway, all the charts are in there. You may not use all of them, but you need to look at all of them. And we'll go through next class how to look at liquidity, how to look at solvent. We'll go through the different pieces. I would recommend, I'm going to be doing Walmart. I would recommend you get the data in for your companies onto your spreadsheet, maybe copy and paste it as values. So as I'm going through Walmart, if your company is doing something wild, you can share it with the class and we can talk about how would you handle that. So working capital is a big one. We'll talk about that. So what is working capital? First of all, let's start with, we got 5 minutes and this is the toughest one. What is working capital? First of all, what's a working capital asset? Inventory is one. Accounts receivable. Well, assets. All right, so cash is not. Cash is a current asset, but it's not a working capital. So working capital is an asset that's directly tied to the operations. All right, cash is the result of operations, right? It comes out of operations. There's maybe one more, maybe prepaid assets. I don't know how to spell receivable, but maybe Bill Gates does. What are your working capital liabilities? Accounts and trade payables. You got two more really important ones. Huh?
Accruals?
Accrueds, yeah. That's kind of your expenses. Bill Gates, I don't think he thinks that's a word. But And what's the last one? I give you a hint that it's maybe the biggest positive of being an airline.
Deferred revenue.
Unearned revenue, so your working capital requirement is working capital assets minus working capital liabilities. That's your requirement. Would you rather that be a positive number or a negative number? Yeah, negative is good. But what did the accountant say? You want a current ratio greater than 1. Now that's current assets over current liabilities. Current assets includes cash. It's not a working capital asset. What does working capital liabilities not include? That's in current liabilities. Short-term debt, all right? So you notice I don't use the current ratio. So one of the most liquid firms in existence is Walmart. Where everywhere you go, it's like people kind of say Yahoo's trying to make money again, and boy, they're irritating me in their attempts. So let's look at their balance sheet. So their current assets are 79 billion. Their current liabilities are 97 billion. They have a current ratio below 1. Is Walmart illiquid? Absolutely not. It's one of the most liquid companies out there. Now, I've heard accountants say sometimes the current ratio doesn't work. So Walmart is liquid despite having a current ratio below 1. I would say Walmart is liquid because their current ratio is below 1. It's not despite. It's not like there's some freaky thing going on. Why is that? Well, what's in their current assets? Inventory, that's their biggest one. What's in their current liabilities? Accounts payable. What does Walmart do? It buys stuff, sticks it in their store, they sell it, they get their cash pretty quickly from the credit card companies. And then what do? They pay their vendors a few weeks later. Does that sound like a good model? Would you rather they pay their vendors up front and then their customers pay them 30 days later? Would that be a better model? That'll give you a higher current ratio. So would you rather your customers owe you money or pay you cash today? Would you rather your inventory sitting in warehouse or be walking out the door being sold to your customer? Would you rather pay your vendors today or pay them 30 days from now with no interest costs? Yeah, would you rather pay your employees today or for what they work today, or pay USA pay me 1 week after I work 2 weeks? What interest did USA pay me for the 3 weeks I worked and for those 3 week delay? Zero. What do you think about zero cost liabilities? Are they good? If I loaned you $1 billion at 0%, will you take it? I know Dave Ramsey, someone asked Dave Ramsey a question, said, no, I wouldn't do it. It's like, yeah, that's a stupid answer. If I'm gonna loan you $1 billion at 0%, would you take it? Yeah, stick it in T-bills for a year. Why not? So we'll talk about that one, but we'll talk about the working capital requirement. So we'll stop it there.